how did the central bank, the institution sworn to keep our economy stable, quietly end up becoming this huge, unelected driver of government debt and, well, economic inequality?
Welcome to the Deep Dive. Today, we're going to unpack the, frankly, stunning expansion of the Federal Reserve's power. It's really not just about tweaking interest rates anymore. We're digging into how the Fed gained this sort of de facto fiscal role, controlling whole markets, and, maybe most importantly, making it way too easy for Congress to spend trillions.
Yeah, and the scale, we just have to start there. It's massive. Since the 2008 crisis, the Fed's role just exploded. By late 2021, its balance sheet, its portfolio hit an incredible $8.6 trillion.
$8.6 trillion.
Exactly. To put that in perspective, that was around 36% of the entire U.S. GDP. So this huge intervention, it's created a situation where the Fed looks less like a traditional central bank and more like a sort of appointed fiscal body, allocating credit, funding the government, but without the accountability Congress has.
Right, and that's the core issue we're exploring, isn't it? This idea of huge power, huge discretion, but disconnected from democratic accountability. Our sources argue this whole environment has, well, destabilized things. It favors financial speculation over just, saving money. It's worsened inequality. And it's brought us to this point where massive government debt might actually stop the Fed from doing its main job, controlling inflation. Let's get into it. Okay, first up. This whole mandate thing. The Fed always talks dual mandate, right? Maximum employment, stable prices. But the sources we looked at keep bringing up a third part, one that often gets ignored. What is that, and why is it suddenly so relevant with the Fed being so big?
That's a great point. The actual law, the Federal Reserve Reform Act of 1977, it lays out a triple mandate. Yes, maximum employment, price stability, but also, and this is key, promoting moderate long-term interest rates. Now, historically, Fed chairs kind of brushed that third one aside. They figured, well, if you get the first two right, rates will naturally be moderate. But the way they've acted since 2008, especially with quantitative easing, or QE, well, that's pushed the third mandate right to the front. QE is basically the Fed buying up enormous amounts of securities, mostly U.S. Treasury bonds.
Right.
And when they do that, they're directly monetizing government debt. They're essentially creating money to fund government spending. That's fundamentally a fiscal action, whatever label you put on it.
Okay, so if the Fed is, in effect, printing money to buy government IOUs, what's the political fallout? The sources really suggest this has let Washington off the hook, fiscally speaking, leading straight to that mind-boggling $37.4 trillion debt number.
It absolutely does. It creates this illusion that deficits don't really cost much. When interest rates are pushed down to near zero, even huge deficits look affordable, at least on paper. So Congress loses that natural brake on spending the rising cost of borrowing.
Oh.
And this safety net has encouraged some in Washington to lean into ideas like modern monetary theory or MMT. The basic idea being deficits don't matter if you print your own currency because, hey, the Fed's always there to buy the bet.
It sounds like enabling bad habits.
It's exactly like that, like a credit card company constantly upping the limit for someone who just can't stop spending. The market discipline vanishes. So this Fed backstop, this massive balance sheet, it's actually become a key driver of fiscal policy, fueling spending that frankly looks unsustainable.
Okay, so this massive intervention, this de facto fiscal role, it obviously creates winners and losers. Who specifically gets hurt when the Fed holds rates this low for so long and buys up all these assets?
Yeah, this is where the criticism gets really pointed. The post-2008 policies, according to these sources, created a sharp downward equality drag. And it's so powerful that even huge government stimulus checks couldn't really counteract it. The end result, a stunning spike in both income and wealth inequality after 2007.
Wait, hang on. That sounds backwards. The usual argument for QE is that it saved us from a deeper recession, which would have hurt the poorest the most, right? So how can the cure actually cause more inequality? What's the mechanism?
The argument centers on how QE works. It inherently boosts wealth generated through financial market investments. Think stocks, bonds, private equity, even things like venture capital or Bitcoin. It favors those pathways.
Okay.
But it does much less for wealth built through, say, wages or traditional savings, or just owning a home. Think about your average saver, maybe someone retired or close to it. They rely on savings accounts, CDs, safe bonds. When the Fed slams rates down to zero, those safe returns basically disappear. Poof!
Right, you earn nothing on your savings.
Exactly. Your conservative savings just stagnate. It almost forces people into riskier assets just to try and keep pace with inflation. Meanwhile, people heavily invested in the markets see their net worth soar because asset prices are being inflated by all this easy money. The system rewards speculation over prudence. That's the distributional hit.
And it wasn't just broad market effects, right? The Fed actually picked specific sectors to help, blurring that line between monetary and fiscal policy even more. Can you give us examples?
Oh, absolutely. Allocating credit to specific sectors. That's textbook fiscal policy. Just look at the Fed's balance sheet. They hold $2.5 trillion in agency mortgage-backed securities. That's housing debt.
$2.5 trillion.
Yeah, that directly lowers mortgage costs, effectively subsidizing the housing market. It's a choice to favor that sector.
The Fed would say that was necessary, right, to prevent a total meltdown in housing.
That's the justification, sure, systemic stability. But the critics argue the effect is still fiscal, regardless of intent. And it got even clearer in 2020. During the pandemic panic, the Fed set up this huge $750 billion backstop for corporate bonds. And this wasn't just for high-quality bonds, it even included junk bond ETFs.
Junk bonds, really?
Yeah, so they were directly supporting specific private companies and market segments. That's a very explicit fiscal action, arguably way beyond their original mandate. Critics say that's a job for the Treasury, not the Fed.
So we've got an unelected Fed acting fiscally, helping Congress run up huge debts, and making inequality worse by favoring Wall Street over Main Street, essentially. Now, what happens with this colossal $37.4 trillion debt pile, especially now the Fed is trying to raise rates to fight inflation?
Yeah.
It feels like a collision course.
It really is. We're potentially heading into what's called the fiscal dominance trap. The basic problem is this. When government debt is that high, $37.4 trillion, it severely limits the Fed's options. Low interest rates stop being a choice. They become almost a necessity just to keep the government solvent.
How does the debt actually constrain the Fed? Can you break that down? Like, give me an analogy.
Sure. Think of the government like a family with a gigantic adjustable rate mortgage, way bigger than they can really afford. Suddenly, interest rates start going up. Their monthly payments explode. They can't afford it. Everything else gets cut just to make the payment.
Okay, I see.
For the government, the cost of servicing $37.4 trillion in debt skyrockets when rates rise. Our sources are pretty clear. Without some really painful cuts or tax hikes, these debt costs just aren't sustainable at higher rates. So the fiscal dominance trap happens when the market knows this. Investors start thinking, okay, if rates stay high and the government budget blows up, Congress won't stand for it. They'll pressure the Fed to step in, buy more debt, and force rates back down.
So the Treasury's need to borrow money dominates the Fed's need to control inflation.
Precisely. Fiscal needs dictate monetary policy.
Wow, that sounds like, well, the end game for controlling inflation. If the Fed is forced to bail out the Treasury like that, what happens to prices?
To the dollar. It would likely be catastrophic for price stability. If the market sees the Fed cave to political pressure and just start printing money to keep rates low, everyone will assume inflation is here to stay, maybe get much worse. Inflation expectations would absolutely explode, the dollar would likely weaken significantly, and actual inflation could shoot far, far higher than what we've seen recently. The Fed would basically lose all credibility. They might even have to ditch their 2% inflation target just to keep those long-term government borrowing costs moderate, fulfilling that forgotten third mandate at the expense of price stability.
Okay, so this picture is pretty grim. Mission creep, fiscal actions, too much discretion, enabling debt, worsening inequality, and this looming threat of fiscal dominance. If that's the diagnosis, what's the proposed cure? What do policy experts, particularly those critical of the Fed's current path, suggest to rein it in?
Well, the core critique from groups like, say, the Cato Institute or Heritage Foundation is that Fed policy since '08 has been divorced almost entirely from clear and understandable rules-based governance. They argue for pretty significant reforms, all centered on making the Fed more predictable and accountable, getting it out of the fiscal business.
And what are the specific proposals? Let's go through them. There were three main ones, right?
Right. First, and maybe the most fundamental, narrow the mandate. These reformers say Congress should literally amend the law, get rid of the maximum employment goal and the moderate long-term interest rate goal, limit the Fed to one single job, price stability only.
Price stability only.
The thinking is the best thing the Fed can do for jobs and stable rates in the long run is just keep the value of the dollar stable. Everything else invites political meddling and mission creep.
Okay, makes sense from that perspective. What's the second point? It deals with that huge balance sheet and the Fed acting fiscally, right?
Exactly. They want to end the Fed's fiscal role and shrink the balance sheet. Two parts to this. First, repeal those extra powers given by Dodd-Frank, the ones related to financial stability, and move bank regulation somewhere else. Second, force the Fed back to what's called a scarce reserve system.
Scarce reserves. What's that?
Think of it like this. Right now, the Fed floods the banking system with trillions in cash reserves, giving it immense control over rates. A scarce reserve system means the Fed keeps reserves much tighter, much scarcer. Banks then have to borrow and lend reserves among themselves more, letting market forces play a bigger role in setting short-term rates. It limits the Fed's ability to just, inject massive amounts of cash whenever it feels like it, like with QE.
Got it. Less intervention, more market discipline. And the third proposal, it's about transparency and rules, isn't it?
Yes, and arguably the most crucial for accountability, require a policy rule. Congress should mandate that the Fed adopt and follow a clear, simple, monitorable policy rule. Think something like a Taylor rule, which links interest rate decisions to inflation and economic output, or maybe nominal GDP level targeting NGDPLT.
NGDPLT. Can you quickly explain that one?
Sure. Nominal GDP level targeting means the Fed aims to keep the total dollar value of economic activity, nominal GDP, growing along a steady, predictable path. If GDP growth falls short one year, they promise to make up for it the next year, and vice versa if it runs too hot.
Ah, so it provides a clear target path.
Exactly. It provides an anchor, a clear goal. The Fed would then have to publicly explain, in detail, any time it deviated from that pre-announced rule or path. It replaces murky discretion with transparent, predictable action.
Okay, let's try to sum this up. We've explored how the Fed's huge post-2008 actions, that $8.6 trillion footprint, are argued to have destabilized the economy in some ways, worsening inequality by boosting financial assets, creating the easy money environment that let Congress rack up $37.4 trillion in debt. And we've heard this compelling case from critics arguing for a return to rules, focusing the Fed solely on price stability to restore fiscal sanity and market integrity.
That really captures it. The fundamental choice ahead is stark. Will the Fed keep playing this high discretion sort of quasi-fiscal role, essentially acting as a tool to help finance seemingly endless government borrowing? Or will policymakers, likely Congress, force a shift back to rules-based policy, a shift aimed at restoring market principles and the kind of accountability needed for long-term economic health?
And here's something to leave you with, a provocative thought perhaps. Historically, central banks using their power to heavily manage or suppress long-term interest rates to monetize debt. That was usually reserved for major wars or truly severe economic crises. What does it signify about the health of our economy, maybe even our democracy, when that kind of extraordinary intervention becomes almost routine, demanded simply to finance massive peacetime deficits year after year? It's not just abstract economics. It touches on the core of fiscal discipline. Something to ponder. We'll see you next time on The Deep Dive.